Welcome. Where, Nda, Dumalang, Molo, Sawubona, Hukandat, and a warm welcome to the Induvo Knowledge Cast, the podcast where your curiosity meets insightful conversations.
Huh.
Today, we're diving into a topic, well, it's often seen as, for accountants, but, and this is important, it impacts all of us, especially, I think, here in South Africa.
Yeah.
We're talking about the, what's it called? Oh, right, the Conceptual Framework for Financial Reporting.
Now, before you switch off thinking, oh no, not spreadsheets, this is a snooze fest, I promise it's not.
We've got excerpts from the International Accounting Standards Board's Conceptual Framework for Financial Reporting. You can think of it as the rule book, the Bible, the trusted confidant for how companies report their finances, ready to make sense of those balance sheets and understand what those numbers really mean.
Absolutely. Let's unpack this.
So before we even glance at a balance sheet, let's talk about this conceptual framework. What's the big deal with it, and why should we care about how companies report their finances in the first place?
Imagine you're at a market, trying to buy a juicy watermelon. You wouldn't just hand over your hard-earned rands without checking if it's ripe.
Right.
You give it a good knock, maybe even smell it, to assess its quality. Financial reporting is similar. It's about providing you with the information you need to assess a company's financial health, to see if it's a juicy opportunity or a potential lemon.
So it's about giving us the tools to make informed decisions.
Yeah.
Whether we're seasoned investors or just trying to understand a company's annual report.
Precisely. The conceptual framework lays the foundation for financial reporting by defining key concepts and setting standards for how companies should measure and report their financial information. It's about creating transparency and building trust in the market.
No more dodgy deals hidden under a mountain of confusing numbers. I like the sound of that. So where do we even begin with this framework? It talks about things like assets and liabilities, which honestly sound a bit intimidating.
Don't worry, these are just fancy terms for concepts that are actually quite straightforward. Let's start with assets. Think of an asset as anything your business owns that has the potential to generate future economic benefits. It could be something tangible, like your delivery van, or something intangible, like a patent for a brilliant new invention.
Okay, so my prized collection of Springbok rugby jerseys, even though I wouldn't sell them for the world, those wouldn't qualify as assets for my business.
Probably not, unless you're planning on starting a rugby museum. The key here is the potential for those assets to bring in some cash or provide other economic benefits for your business.
So, if I decide to rent out my bakkie as a moving van on weekends, that bakkie suddenly becomes an asset on my business books.
You got it. That bakkie is now a resource your business controls, and it has the potential to generate income for you, which means it ticks all the boxes to be recognized as an asset.
This is making more sense already. But what about the flip side? Those liabilities, they don't sound nearly as fun.
No. Liabilities are definitely not as much fun to think about, but they're just as important to understand. In simple terms, a liability is any obligation your business has to pay someone else. This could be anything from outstanding invoices from suppliers to a loan you took out to buy that bakkie in the first place.
So, if I borrowed money from my cousin to buy that bakkie, that loan becomes a liability for my business.
Exactly. And those liabilities are important to track because they represent future outflows of your business's resources. Money you'll eventually need to pay back, which can impact your overall profitability.
Okay, so assets are like the players on your team, working to bring in those economic benefits. Well, liabilities are like the referee, always there to keep you in check and make sure you're following the rules.
That's a great analogy. It's about understanding the interplay between the two and how they work together to paint a picture of your business's financial position. Now that we've tackled the building blocks of assets and liabilities, let's move on to the engine that drives a business: income and expenses.
Ah, yes, the lifeblood of any business. Those two little words that can either make or break an entrepreneur's day. Where do we even begin to unravel these concepts?
Well, let's think of it this way. Imagine you're running a shisanyama stall. The aroma of your legendary braai wafting through the streets.
Yeah.
Every time someone hands you money for a plate of your delicious meat, that's income. The inflow of cash or other economic benefits from your business activities.
Every time I sell a plate of my famous Boerewors rolls with that secret chakalaka sauce, that's income for my business. And that income increases my assets.
Absolutely. That income could increase your cash on hand.
Right.
Or it could increase your receivables if you're letting those loyal customers pay you later, like a tab system for your most devoted braai buddies.
Makes sense. But those delicious boeries don't magically appear on the grill, do they?
Oh.
We have to factor in the costs of running the show, the expenses.
Exactly. Expenses are the other side of the coin, the outflow of resources.
Yeah.
Like cash. that your business incurs to generate that mouthwatering income.
So
Hmm.
we're talking about the cost of the meat, the charcoal, the spices for that secret chakalaka sauce, maybe even the rent for my stall.
Right.
All those costs that come with keeping the bry fires burning.
You've got it. And those expenses are crucial to track because they directly impact your profitability.
Yeah.
The difference between what you're bringing in and what you're shelling out.
So if I'm spending more on those fancy imported spices for my chakalaka than I'm making from selling buris, that's a clear sign that I need to rethink my pricing strategy.
Exactly. Understanding the relationship between income and expenses is like keeping an eye on the petrol gauge in your car. You need to make sure you're bringing in enough fuel revenue to cover the distance you're traveling, your expenses, and reach your destination profitability.
That makes a lot of sense. But it can't be as simple as just tracking our income and expenses.
Right.
There must be rules, guidelines, and maybe even a few curveballs thrown in for good measure.
You're absolutely right. And that's where the conceptual framework steps in again, specifically with the concept of recognition.
Now, when I hear recognition, I think of getting a standing ovation after a rousing performance. But I have a feeling that's not quite what we're talking about here.
Right. Not quite. Although a perfectly balanced balance sheet does deserve a round of applause. In accounting, recognition is a bit more technical. It refers to the process of formally recording an item in your financial statements, whether it's an asset, a liability, income, or an expense.
So, it's about deciding which financial events are significant enough to make it onto the official record. Kind of like choosing which players deserve a spot on the Springboks starting lineup.
That's a great way to put it. Not every financial event makes the cut. There are specific criteria that need to be met for an item to be recognized in the financial statements. First and foremost, the item needs to meet the definition of an element. Is it an asset, a liability, income, or an expense?
Okay, so we need to make sure it fits into one of those categories. What happens once it's earned its place in the lineup?
Then comes the second crucial question. Will recognizing this item provide useful information to the people who rely on these financial statements?
Useful information. So it's not just about throwing numbers on a page. It's about making sure those numbers tell a story that people can actually understand and use to make informed decisions.
Precisely. That's where the concepts of relevance and faithful representation come in.
Okay. Now you're speaking my language. Tell me more. What makes financial information relevant in this context?
Imagine trying to find your way around Johannesburg using a map of Cape Town run. Not very helpful, right? Financial information needs to be relevant to the decisions being made. It should help users understand a company's past performance, assess its present financial position, and even make educated guesses about its future prospects.
So, no more hiding those dodgy deals in a maze of irrelevant numbers. Transparency is the name of the game.
Exactly. And that brings us to the other key characteristic of useful financial information: faithful representation. This means that the information presented in the financial statements should accurately reflect the economic substance of the transactions and events that took place.
So, no trying to disguise a dud investment as a golden egg.
Right. Again, it's about presenting a true and fair view of the company's financial performance and position, warts and all.
I'm starting to see how this all ties together. It's about creating a system where companies are held accountable for their financial actions, and where investors and the public have access to reliable and transparent information.
That's exactly it. But even when an item meets the definition of an element and provides useful information, there's still the challenge of figuring out how to put an accurate number on it.
That sounds like a potential minefield, especially when you're dealing with things that are a bit fuzzy around the edges.
Yeah.
How do you even begin to measure something like brand reputation or the value of a loyal customer base?
You've hit on a crucial aspect of financial reporting: measurement. And you're right, it can be tricky, especially when we're dealing with intangible assets or situations with a lot of uncertainty.
So, how do we navigate this measurement maze? Do we just throw darts at a board and hope for the best?
Thankfully, there's a bit more structure than that. The conceptual framework provides guidance on different measurement bases, the methods used to determine the monetary value of those elements we're trying to recognize.
Okay, so instead of darts, we have measuring tapes. Tell me more about these measurement bases.
Two common measurement bases are historical cost and fair value.
Now, those are two terms I've come across before, but I'll admit, I'm still a bit hazy on the details. Could you break them down for me?
Of course. Historical cost is like looking in the rearview mirror. It values an asset or liability at the price it was originally acquired for, adjusted for things like depreciation or amortization.
So, If I bought my trustee Backy 5 years ago for R100,000, even though its value has probably gone down since then, its historical cost on my balance sheet would still reflect that original purchase price.
That's the gist of it. It provides a reliable and verifiable figure, but it might not always reflect the current worth of that asset, especially in a market where prices fluctuate like a taxi fare during rush hour.
Which brings us to fair value, the more forward-looking approach.
Exactly. Fair value is all about capturing the current market value. What that asset or liability could be exchanged for between willing and knowledgeable parties in an arm's-length transaction.
So, if my Backy has become a vintage collector's item, those old Toyota Backies are indestructible.
Yeah.
Its fair value might be significantly higher than its historical cost.
You're spot on. Fair value aims to provide a more realistic picture of an asset or liability's current worth. But it can also be more subjective and complex to determine, especially for things that aren't actively traded in the market.
So, it's about finding a balance between reliability and relevance, between looking back at past transactions and considering current market conditions.
Precisely. And the choice of measurement basis can significantly impact a company's financial statements and the decisions made based on them.
This is getting juicy. It's like trying to figure out the best way to braai a boerewors. Low and slow over the coals for that traditional flavor, or a quick sear on a hot grill for that perfect char. Both methods have their merits, but the choice depends on your desired outcome.
What a brilliant analogy. And just like there's no single right way to braai a boerewors, there's no one-size-fits-all approach to measurement in financial reporting. It depends on the specific circumstances, the nature of the item being measured, and the overall objective of the financial statements.
This has been incredibly insightful. But before we get too lost in the finer points of measurement, I'm curious about the bigger picture. How does all this information come together to tell a coherent story about a company's financial performance and position?
That's a great question. And it brings us to the final piece of the puzzle, presentation and disclosure.
Okay. I'm intrigued. We've gathered our ingredients, measured them carefully. Now it's time to plate up this financial feast.
Exactly. It's not enough to simply have all the numbers. We need to present them in a way that is clear, concise, and easy to understand. Think of it as the difference between handing someone a jumbled box of puzzle pieces and giving them a beautifully framed, completed puzzle.
So how do we go from a jumbled box of numbers to a beautifully framed financial masterpiece? What are the key principles of presentation and disclosure?
One key principle is aggregation, grouping similar items together and separating dissimilar items. It's like organizing a braai. You wouldn't throw your bars, your pap, and your chakalaka all in one big heap, would you?
Now that's just chaotic. I like my braai spread like I like my financial statements well organized with a clear separation of elements.
Exactly. This principle of aggregation helps users to easily identify trends, compare information across different periods, and even compare the performance of different companies within the same industry.
Makes sense. So we've carefully categorized our financial ingredients. What's next on the menu for crafting those delectable financial statements?
Next up is avoiding information overload. While transparency is crucial, we don't want to bombard users with a mountain of insignificant details. It's about finding that sweet spot between providing enough information to be useful without overwhelming the reader with unnecessary minutia.
So it's like a well-crafted bunny chow. Generous portions of deliciousness without the avalanche of fillings.
Precisely. We want to ensure the information is digestible. This means striking a balance between presenting aggregated totals to provide a broad overview and disclosing sufficient detail in the notes to the financial statements to explain those totals and highlight any significant items or trends.
Okay, so aggregation helps us organize the information, and avoiding information overload ensures it's digestible. What else do we need to consider for a truly masterful presentation?
Think about those cooking shows where the chef meticulously arranges each element on the plate for maximum visual appeal. Similarly, in financial reporting, we want to present the information in a logical and structured manner, using clear headings, subheadings, and visuals like charts and graphs where appropriate.
So it's not just about what we present, but also how we present it.
Exactly. A well-presented set of financial statements is like a good story. It's engaging, easy to follow, and leaves the reader with a clear understanding of the company's financial journey.
This has been incredibly enlightening, but before we wrap up our deep dive into the world of financial reporting, I can't help but wonder about the so what of it all. Why should we as individuals care about these concepts?
That's a crucial question. Understanding these concepts gives you, the individual, a superpower. You become equipped to make more informed decisions.
Okay, you've got my attention. Tell me more about this financial superpower.
Imagine you're considering investing in a local business. Maybe that Shizunyama stall we talked about earlier. Wouldn't it be helpful to be able to analyze their financial statements, understand their profitability, assess their debt levels, and make a judgment call on whether it's a worthwhile investment?
That would definitely save me from some potentially burnt investment.
Exactly. Or let's say you're about to sign a lease for a new flat. Understanding the landlord's financial stability through their financial statements could give you insights into whether they're likely to maintain the property, address maintenance issues promptly, or if there's a risk of them, dare I say, disappearing into the sunset with your deposit.
Knowledge is power. Indeed. This has been an incredible journey. We've gone from feeling lost in a sea of financial jargon to navigating the intricacies of the conceptual framework. Who knew that understanding the language of business could be so, dare I say, empowering?
Absolutely. And remember, this is just the beginning. The world of financial reporting is vast and constantly evolving, but by grasping these fundamental concepts, you've taken a significant step towards becoming a more informed and empowered individual.
And that's a wrap for today's deep dive. We hope you've enjoyed this deep dive into the fascinating, and dare we say, surprisingly exciting world of financial reporting.
Until next time, stay curious.
And remember, when it comes to understanding those financial statements, always ask questions, stay informed, and never be afraid to take a closer look. Until next time on the Induho Knowledge Cast.